How you guys doing? Dr. Murphy, Alex, you guys can hear me all right?
I can hear you. Coming in loud and clear. Hi there.
Wonderful. It's great to have you both on stage, and we'll kick things off here. Very excited to have you guys both here for our exciting real-world asset tokenization space. Today, we're taking a little bit different of an angle, and we're going to be focusing on CBDCs versus stablecoins and the future of the digital euro. And to really help us dive into this topic, we have a stablecoin expert from Stasisnet, Alex. That's the account Crypto Walker you see up there. And we're very, very excited to dive in. We have our in-house expert, our chief economist, Dr. Murphy, that's going to be providing his insight and helping guide the conversation. If you guys have any questions along the way, please feel free to drop them under the pinned tweet, and we'll be sure to work those into the conversation. With that, we can dive in. Alex, would you like to introduce yourself and Stasis before we kind of dive into the meat?
Sure. Just as announced, does this sound good?
Yeah, sounds perfect.
Yeah, well, hello there. My name is Alex, and I'm CMO at STASIS. Thanks for the invite, Jackson. Robert, nice to see you here, sir. It's been like 2 months since we met initially, I guess. Well, it feels like been a lifetime in crypto. It goes so fast. A lot of different developments, partnerships, and most of them are positive. So, long story short, and I mean really long, because we've been around for 7 years as a company. So, STASIS is a European Web3 fintech originated in Malta. And we started out as a tokenization firm, but the only thing we managed to tokenize was the euro currency, and still remains our core product. So we used to develop different customer-friendly instruments, public blockchains. Right now, we're focusing completely on this product, which is STASIS Euro, or EURAS, the largest, the most transparent and trusted European stablecoin, one of the dozen products available in the European market. And we try to make it the proper instruments for people, companies to enter, to operate with the DeFi, different marketplaces, instruments. So we have 4 streams of verifications, successful globally in 175 countries, audited by the top auditor, which is the BDO. And all the assets are backed on one-to-one basis with liquid euro balances or simply cash reserves held with the Lithuanian Central Bank. And let's leave it there because I can go along for hours. Back to you, now.
That's great. Thank you for that introduction, Alex. And I'm sure that we'll dive in more throughout the conversation. And Dr. Murphy, would you like to give a quick introduction for the listeners who may not know you?
Sure. So I am the economist here at Infineo, and what we're doing at Infineo is taking life insurance and putting it on the blockchain, tokenizing it. But we also are very interested both, in terms of just the overall space, but in terms of applications for our business model that we need to be able to convert back and forth with, state-issued fiat currencies, and obviously stable coins are something that's necessary in that. So, of course, we need to understand them and to, have views on them. And also, of course, the CBD is something that's very concerning to a lot of people who've been building these parallel rails of finance. And so that's also something to do. I'm just really looking forward to this conversation to see the ways in which CBDCs are similar to, but of course, quite distinct from privately issued stablecoins. So I'm excited to continue this conversation.
Great. Thank you, Dr. Murphy. And for those listening, I'm Jackson Blau, our Director of Business Development at Infineo. I host our biweekly X Spaces. And if you're ever interested in joining us, please send us a DM. And with that, let's dive into this conversation. And thank you for that introduction, Dr. Murphy. It very eloquently took me to the first topic, which is actually going to be differentiating between CBDCs and privately issued stablecoins. A lot of the time, people look at stablecoins and they see them as kind of the gateway potentially to a CBDC. But I personally, with my experience in blockchain, view them as completely different products. Alex, I'm very curious to hear your definition of CBDCs and privately issued stablecoins and how they're different.
Actually, I'll try to make it brief because it's a very extensive topic. So what we see is while the world holds its breath for the advent of European-led digital euro, you can call it CBDC, as alternative, has been around flourishing for years, for 6 years, obviously. So CBDC is what people refer to central bank developed and led digital currencies. It's completely different to what we have in mind as the digital euro. So EURAS, or STASIS Euro, operates as a fully transparent, open-sourced, one-to-one euro-backed digital asset designed to bridge the gap between traditional market and flourishing decentralized finance ecosystems. And unlike CBDCs, which are digital representations of a nation's fiat currency controlled by central banks, ERS is privately issued, answering to a decentralized framework that promotes financial inclusivity and flexibility. With our multi-chain presence on some blockchains now and transparent infrastructure, ERS offers an alternative that integrates seamlessly in both centralized and decentralized framework systems. It provides users with a robust and secure digital currency that maintains full reserves at all times. So, long story short, there are no caps like you face with CBDCs. As there are no unified framework globally, European CBDC is going to have a limit of just €3,000 per account. That's it. Think of it as a change of monetary system, like your small coins, right? You have metal. It will be replaced by the digital euro, which is CBDC. So it's going to be on different tech stack. It's not going to be an open blockchain, and it's going to have different utility, smaller payments, that is. So it completely cuts up decentralized finance. Other interesting use cases we have, or other stablecoin issuers experiment with. So that's it. You use for payments. You're capped at 3,000, and it's not really public ledger. It's highly traceable, and of course, traceability is one of its features. So that's it. And of course, it doesn't have the possibility to develop and integrate with other emerging ecosystems and Web3 at all. So you're being completely cut off of crypto, operate with this very centralized data ledger, and their story.
That makes a ton of sense to me and very much explains kind of how I look at them as being completely different products. Dr. Murphy, given your experience just with cryptocurrencies and blockchain, and furthermore with economics and more just philosophy and Austrian economics, I know you feel some type of way about central bank digital currencies. Would you like to chime in here and potentially share how you view the difference between central bank digital currencies and privately issued stablecoins?
Yeah, sure thing. And so let me first, I'll try just to explain like the taxonomy and just how I, as an economist, like you say, but was familiar with the existence of digital assets, how I look at the distinction between the two things. I think what I'm saying is consistent with how Alex laid it out there. And then I'll just, I'll try to do that as fast as possible. And then also add my opinions on, how do I feel about these things. But I'll try to keep it first, just the facts, and then what views are about it. So yeah, I think a stable coin, that's easier to start with. So again, it is a coin. It lives on a blockchain, and what it purports to do, its ostensible goal is to maintain its market exchange rate with some other designated asset. And so, in the context here, things like the US dollar or the euro. And so really to be a US dollar stable coin, it just means this is a coin that there's mechanisms in place that in principle at least should keep this thing trading at close to parity with the US dollar, or, with the euro, that it would be with the euro. And there's different approaches to that. There's algorithmic things, but then, that there were some spectacular failures of that approach. It doesn't necessarily mean the approach is wrong. I'm just saying that's kind of some people. And so what seems pretty safe is, if the entity that's issuing these coins has a redemption pledge, and so if the price of this thing falls below par, right? So let's say something like Tether, the USDT is supposed to be close to trading to $1. And if it fell below, ultimately, Tether has a bunch of dollar-denominated assets that it's holding, and that's how it's supposed to be able to support that floor. That ultimately they could, you could turn in your Tether and get dollars back. At least certain people could, maybe there's a delay, but that's the idea. And so what is it backed up by? That's the idea. And so it has nothing to do with the U.S. authorities, right? Tether doesn't have the legal ability to, quote, print dollars. It's just an entity that, has accumulated a bunch of dollar assets, and then it issues this thing that it says, it will try to keep near trading it close to $1. And so then people, if they have some Bitcoin and it does really well and they want to, quote, take profits, go to cash, they don't have to completely get out of crypto and then turn, wire funds into their U.S. bank account. No, instead they can just sell their Bitcoins for USDT, or, USDC is another one, right? So that's kind of like the economic function of it. So it's just allowing you to stay in your wallet and just transfer out of a volatile cryptocurrency into a stable coin. But again, the nature of them, they're very similar. And a stable coin can be a real asset in the sense that maybe it's tied to underlying dollar-denominated assets or euro-denominated assets, but it doesn't need to. In principle, it could just have some kind of algorithm and have its value pegged by some other mechanism. In total contrast, the central bank digital currency, in theory, the way I'm using the terminology, and I don't know if Alex would disagree, but I think even in principle, it doesn't need to be tied to a blockchain. That's, just terms of the letters and the definition. And a central bank digital currency just means, it's not physical. It's not like paper currency, but it just means it's units of dollars or euros that the Federal Reserve or the ECB says exist. And, so in principle, everyone just had a checking account with the Fed, and that's where it was. And there were no more $20 bills, $100 bills. It was just all there. That you could argue would be a CBDC. Now, maybe it would use blockchain, maybe it wouldn't, but I'm just saying, to me, the economic essence of a CBDC is it is legal tender official money that the central banks are issuing. Just like right now, if the Fed buys $1 billion of mortgage-backed securities, that's like, that money gets created in the system. That's legal tender. That's as good as any other dollar is. Whereas again, Tether can't just create dollars, right? It can say that it owes you dollars, but the mere promise of Tether or the debt you might have on Tether, the IOU, is not legally binding. Whereas the Federal Reserve says, here, we're going to buy $1 billion from you, credit your account to that is legal tender. That's as good as it can be. It's as good as having $100 bills, legal, regulatorily. Okay. So to me, that's the distinction between the two. And in terms of how I feel about them, I'll get, the privately issued people, they can't counterfeit in a sense. And so I think that's good, both in terms of the integrity of the underlying purchasing power of these currencies, that to have a bunch of companies issuing stable coins that are, to be pegged to the US dollar, to pegged to the euro, that's not the same thing as just being able to create more money. And so that that's not going to necessarily push up prices at the grocery store. Whereas if the central banks issue more euros and dollars, that will push up prices. So that's one issue. But beyond that, this is the last thing I'll say here, I've been talking for a bit. The fundamental danger that a lot of privacy people experts, pundits are worried about with CBDCs is if it gets to the point where, let's just say in principle, everyone basically has a checking account with the Fed, and everybody, in Europe has a checking account with the ECB, and that's all digital transactions and nobody uses cash anymore. If you get on the wrong side of the authorities, if they don't like you, they don't even have to throw you in jail. They don't have to charge you, so they can just turn off your access to money. And that, if all the merchants typically in your area, your landlord and so forth, if all they do is accept, the European Central Bank's CBDC, and you now don't have access to that, then you're out of luck. That's like, embargo against you as a person. And so anyway, that's the real danger. So the stuff about efficiencies, and to me, that's all happenstance. The real issue is right now, if you have cash, the authorities can't just turn off your $20 bills. They don't have the power to do that. Whereas if everything's going through the sized system of a CBDC, then, that the amount of power they have over people is immense. Okay, I'll stop there.
That was great, Dr. Murphy. And again, I think very, in a great way, summarized the differences between privately issued stablecoins and CBDCs. And you really started hitting on the main difference, in my opinion, which is really the transparency and safeguards. And so, Alex, I'd love if you could potentially speak a little bit to, I know we spoke a little bit about the full euro backing, but if you could speak a little bit to the transparency and safeguards of yours, and how that compares with what you would see with a CBDC, including your guys' multi-chain integration and what that means for the end user.
Sure. I guess Dr. Murphy's answer was very thorough. I'd just like to add that indeed, with CBDC in place, they can cut you off a financial system, what we've seen in the movies, like futuristic ones, that might be some not so distant future indeed. So with us, or with any, let's say, open source stablecoin, it's hard to do. So Web3 is not censorship resistant, but we're getting there. And that's the whole concept of crypto, probably to try and shift your wealth from the blockchain, to preserve your wealth, to truly own something, right? Something cannot be taken from you. Same story with us. We can onboard customers and we can help to onboard millions of customers' funds store securely. But nothing comes without risk. The job is to mitigate risk. So provide less risky products for the masses, corporations. And of course, there's KYC in place with us. And of course, there's some freezing functions that work with us, with Tether, with Circle, still there. But still, it's not like somebody will just switch you off for nothing. And the whole concept of privately stablecoins, end of the day, to deliver less friction experience, to help feel empowered with what you owe. Okay, I'll stop there and I'll continue with the topic as we are short in time and have a lot of topics to discuss. So when it comes to transparency and the safeguards, one of our core principles behind this whole technology and the asset is ensuring a high level of trust and security through multiple layers of verification and transparency. We have 4 right now. As we work with BDL Malta, our reserve holdings are meticulously audited, with all reserves fully collateralized by fiat euros, meaning that euros issued, there is a corresponding euro held in reserves. Furthermore, our multi-chain approach, as we operate on 7 different blockchains, enhances the security and resilience of the stablecoin. Mitigate risks that could arise from any single-chain dependency, as we saw previously with ETH, as we launched on Ethereum in 2018. Then we see like DeFi summer, we see high fees, and we saw a situation where literally you have to send €100 with Stasis wallet, and you have to pay 120 for that. Well, very good idea. Yeah, you have to go multi-chain. So this multi-phased verification process, this multi-phased process of interacting with the DeFi and other application is the backbone of our system. We are a completely centralized stablecoin. Different models, and as clear as you guys mentioned, algorithmic models, other models exist, but they fail to some extent. We don't see the need to make a fully decentralized stablecoin and to experiment with our core model. We believe in centralized model of stablecoin, but decentralized solutions to empower people. As fun as it sounds, it works for now, and I think it works for the next few, maybe more years. We've seen a lot of issues in the crypto space, but not with the fact of how our setup was made. So we'll continue our mission as a centralized entity because there are rigorous QIC checks in place. Our QIC provider sits in Switzerland as our Swiss on-prem solution or platform, which is SCB. So with that setup, we can effectively serve almost all the countries. And there are human verification checks. They're not still automated, so they're rigorous. So ensure all the customers are legal and companies can be effectively served within 2 business days, customers within 1 business day, 24 hours. It's not still 24/7, but we're getting there. And we have launched a bridge to exchange our asset across, just called Stasis Bridge, with MTs and external technologies, completely in-house. So yeah, you can go to the website, Stasisnet/transparency, and you can see all the assets we have. Clients funds on the left, breakdown, right? You see allocation across the blockchain layers, and it's updated daily. The same goes for transparency statements. It's uploaded to the website on a daily basis. So customers can be ensured that the money is there, and it's all legit. Nothing questionable, nothing shady about it. That's our approach to transparency. It was our backbone since the very foundation many years ago. Nothing changed. Back to you now.
Incredible. And that was really perfect. Thank you again for that, Alex. We focused a lot on CBDC, central bank digital currencies, earlier, and I think that we can all agree on this panel we're not a fan of them. But I honestly would be a little remiss to not ask the question, do you guys think, and we'll start with Alex here, that there is a potential for central bank digital currencies and stablecoins to coexist in global payments? Or is it really that they're serving the same function and stablecoins are really better at serving that function? Alex, I'd love to hear your opinion.
Sure, Jackson. I feel they will coexist. And we had a lot of inquiries whether our asset or company, whole sector will be annihilated with the advent of CBDCs. It will not. It will not go away. I think it will coexist, whether it's US or Eurozone or Asia, whatever, because these are different use cases, as we both here explained. So payments, they're going to be influenced by the CBDCs. And probably a lot of people are not excited to go into details. They're just excited by innovation. They will embrace CBDCs. They'll not care. They'll use it for payments. Maybe that will go for senior generations that are not so open to experiment with a blockchain tech or find it risky, or people who just want simplicity, right? So embrace CBDCs, but still, you cannot a lot of money with it in the Eurozone. I don't know what's going to be the solution for the digital dollar or digital yen or any other state-launched digital asset, but probably the limit's going to be strict, and any money you have excessive kind of money, they'll be in your banking account, maybe savings account. So CBDCs are going to be a means for payments, more payments like shops, groceries, probably that kind of stuff, payment cars, utilities. So I think it will coexist, and you can do a lot with the crypto dollar, crypto euro, which is like Tether or USDC, and those entities will of course, remain monopolies to some extent, and they will continue to polish their products as there is a lot of use cases, more will arise. So right now, there's a lot of cases when you can buy, let's say, a house with the stablecoins or pay for a luxury car, but mostly we see this for valued customers, not so much for ordinary Jews. There's a use case with us. Our latest use case we have, quite unique one, is the ability to pay for a luxury yacht with the IRAS. It arrived just a month ago. We signed a contract with a Maltese company, and they've been dealing with this stuff for years. So now it's possible to accept crypto, accept IRAS for this kind of payments, but it's still a long way to go before that comes to real life, right? More retail adoption. For us, I've been experimenting a lot with crypto cards like Wires, for example, or Holohealth that enables real-life payments on products like coffees, pizzas, or I don't know, and smaller payments. So CBDC is going to be used for that, but open source stablecoins will also be used for that. But of course, people will choose both, I guess. Different stack, different technology, different target markets. There is no problem for you to choose CBDC and use it for one purpose and use stablecoins like ours or others for other purposes to run with the DeFi. Let's say with IRAS, DeFi is a huge use case. I would say we're bullish on decentralized finance, and we are present in more decentralized exchanges than centralized. Basically because we're on the same mission to empower people. We don't have to pay a lot of listing fees as we are embracing this smooth time, I would say, marketing approach, stealthy in the kind of way. So we didn't pay for listings right now. It's coming down naturally. Right now, you can get double-digit yields at DeFi and many protocols and different blockchains like Algorand, for example. You can get 20, 30, 40% yield on IRAS, APR, which is perfect choice when you hunt for those, because in the Eurozone, there's a period when you see basically negative yield on your savings, the zero yield. Right now, the rates are rising, but you never know. It's a chaotic, volatile environment. TradeFi, DeFi, no matter what. For us, it's to empower people through the blockchain technology and offer them more alternatives than traditional world provides. Thank you.
Yeah, so thanks. I'll take a shot at your question there, Jackson. So in terms of just what do I think is coming, I definitely think CBDCs are coming. I think there's going to be robot dogs that break into people's houses and help them get arrested if they get on the wrong side of the authority. So I think that's coming, whether it's a good thing or a bad thing, I'll let the listener decide. But and I think stablecoin, privately issued stablecoins are here to stay as well. Certainly different countries might crack down on them or something, but certainly on planet Earth, there's going to be humans who hold stablecoins too. So I think they're definitely going to coexist. Let me just mention, this is a point that I owe to George Gammon when he first made it. And I was like, oh yeah, that when people started floating the idea of bank digital currencies, they were calling it, at least in the United States, they were calling it Fed coin. The Federal Reserve is issuing its own coin. Oh, let's call it Fed coin. And people were saying, who the heck would adopt Fed coin? Why would you do that? If you wanted to hold a coin, you could hold Bitcoin, or if you didn't want the volatility, you'd hold a stable coin. But why would you ever want to hold Fed coin? You just stick to dollars. And George's point was, exactly. So that's why he thought that isn't going to work. It's not that the central banks, he thought, were going to issue their own rival cryptocurrency that, was just controlled by them and it wasn't decentralized and so forth. And so that's, he was saying, no, he thought it was going to be more like the United States, a more plausible process by which Americans could be converted into using a CBDC in daily transactions. He thought it would be, if there's a conventional banking crisis and a bunch of private banks, they're having runs or whatever, and people can't get their money. And then the Federal Reserve, what if the way they kind of come in and rescue people is they say, hey, you know what? You were supposed to have $18,000 in your checking account at this bank that just failed. Instead of you waiting for FDIC to come in and do a workout plan, and then you go over here to JP Morgan or something, how about we'll just grant you a direct account with the Fed, and we'll credit you with the $18,000 that we had been federally guaranteeing anyway in your checking account, and then so it would still be dollars. It's not that it would be turned into 18,000 Fed coin. It would still be called U.S. dollars. It's just what you would have now is a checking account with the Fed, so that the Fed's liability would include the deposits that people thought they had with the central bank. And so George's point was, if it were like that, that's basically a CBDC in terms of, its economic features. So anyway, I'm not saying that's necessarily going to happen. The private banks have a lot of political power in the United States, perhaps more than in other countries. The Federal Reserve is literally owned by private banks in the U.S., whereas, that's not necessarily the case with other central banks around the world. So I'm not saying that's going to happen, but my point is just, I want to make sure I say before we move on to another topic here, that when you're thinking of a CBDC, don't necessarily think that it means it's something besides the national sovereign currency unit. It could just be that the way they administer it morphs into, a purely digital form. So anyway, I'll stop there. But yeah, so I definitely think the two are going to coexist with each other. I guess one last thing I'll say in terms of the centralization, in principle, it's not a huge threat to privacy if a privately run stablecoin issuer, it is very centralized. And you could even argue, oh, what if they want to blackball somebody? Somebody criticizes the guy running a particular stablecoin and he just turns them off. I mean, they could do that, but that'd be very bad for business. And the ultimate check is that the reason that's not a huge threat to civil liberties is nobody's ever going to find themselves in a situation where the only way they can buy goods and services is through merchants who only accept, Tether, or who only accept USDC, or who only accept, Alex's Euro stable. That's not going to happen. Whereas you can imagine scenarios where if you lose your ability to get access to actually legal tender US dollars or euros, you could be in trouble. So that's the reason that the central banks, if they decide to, punish somebody, they have way more power over you than a privately. In other words, the only power a private company ultimately has over you is how much you voluntarily hand over to them by using their product. So I guess that's a way of putting it.
That makes a lot of sense to me, Dr. Murphy, and thank you for adding that. I guess for the next topic, I'd love to hit a little bit on what sometimes is what people say the one reason that they would use CBDCs. It's because the tender would be backed by the governments, and it would be the same as the dollars, and they've been around for hundreds of years. They're decentralized institutions that that the tender is going to work, whereas some of the stablecoin companies are a little newer. But I know with yours, you guys have been around for 6 years, and you guys have seen a lot of success and stability. So I'd love if Alex, you could just talk about what's contributed to your success over the last 6 years, and how you see being a private company, a private centralized company, is actually an advantage to yours.
Right. For that many years, we've been trying to make a less risky product with more advantages than other providers, right? Having a proper setup from the start was like the immediate move, as not many companies is right set up, right auditor, and experienced team in place. So the success came when we actually launched, and it was no capitation, it was no regulation, as we have to self-regulate the company back then. And we launched our STASIS app, and not many stablecoin issuers have their own wallet. We make it InFi compatible. Later on, we set up this on-off ramp and that endpoint as well, because not just it's important to have something on-chain, it's important to have a means to buy and sell your stablecoins or digital assets. Well, that's very efficient. You can buy the stablecoin with a MasterCard, you can buy it with a SEPA transfer in the Eurozone, and you can sell it not just sell for euro, you can sell it to 30 plus different currencies if you want to go that. And we have around 80% of clients that come from Eurozone, another 20% that come from emerging countries. But not only, we have around 5 partners in the United States, right? So we're going global, and that was like a starting point, not just to remain, in the Eurozone as in terms of advertising and customer base, trying to appeal to a global audience and experiment with different use cases. As we start from remittance, payments, more of institutional side of things, we then shifted to retail and discovered more use cases such as decentralized finance, NFTs. Now we're excited about incoming Web3 gaming revolution, metaverse. The tag is not there, right? But it's coming probably next few years. Going to be a lot of advancements. So we want to penetrate different markets, different segments of Web3 to be present in as many protocols as possible to experiment with it. When you stop innovating your bank, so with us, you never have to stop, basically. Very active. We're a small team, but in terms of marketing, business development, we're doing our best about the collaboration use cases. Raising awareness, making some educational threads and articles, email campaigns as well as, active there too. So we have more than 100 of different borders, different protocols, then crypto wallets, payment companies, core solutions. And that's it, because not many competitors have this versatility and that's presence. There's flexibility to prosper, to adapt to things. Now, all the 6 years, it was not like a walk in the park. It was a bumpy road all the way through. And it's still challenging just to sustain your presence in this market, not to, make money. We actually consider ourselves being a charity institution because we don't make a lot of money from it. Basically, we try to run it properly and find money for advancements or upgrades between blockchains. And of course, we have some more global things in mind. When the time comes, we're going to reveal that. It's a long-term game because we anticipate the shift from the dollar to different locally procured currencies and the euro as well, because the euro on the blockchain is undervalued. It's, let me tell you, 99% of trades in crypto, they go in USD stables because USD mentality dominates in crypto. But the whole non-USD sector is around like 1%. So, yeah, as this shift will continue the next 5-10 years, we'll anticipate a bigger share of the market. And of course, there's not going to be a lot of different corporations or companies doing the same thing. So the competition will die down. I don't see like it will survive. Hopefully it will. Yeah, as all this most trusted issuer, but there's going to be only a few companies. The same example went on with internet companies 20 years ago, with Coca-Cola products, with automobile industry 100 years ago, you name it. Thanks.
Yeah, I'll take a shot at your question, Jackson. As I understood, what you were wondering is, hey, you guys are beating up on CBDCs here a little bit, in my case, a lot. But isn't it the case that ultimately, somebody's using it just as standard day-to-day transactions, and that if I have an account with the Federal Reserve, I'll speak from the perspective of an American. If I have an account with the Federal Reserve and they say I have $80,000. I don't have to worry that money's going to disappear because the Fed managed its affairs, because they have the legal ability just to create that money, right? Whereas if I have a conventional bank account, it's possible that I go to take my money out and they say, sorry, we don't have it. And even if it's federally insured, there's still a lag there. And then also, if I'm using stablecoins, it's possible that, I could have what I think are $80,000 worth of USD stablecoins, but there could be a market meltdown tomorrow and maybe the par value drops cents. And all the mechanisms I thought were in place by which they would make sure they could, prop up the value at close to parity, maybe those mechanisms fail, for whatever reason. Maybe they were lying about what their backing was, or whatever. It's just a rhythmic thing. Maybe, some weird scenario they didn't think of, and the thing unwinds and crashes. So, isn't that a reason you might want to use a CBDC? So, in a narrow framing of that, that's certainly undeniable. But I just want to point out that it's not that it's good for the system. Okay, so I'll just real quickly make the point that if you have like a stablecoin issuer and they do a good job of maintaining confidence because they have really liquid asset denominated in that currency that are all very short term, that sort of thing. Ultimately doing is just taking other people's savings and transferring it, to the people holding the stable coins. And then, the relative safety of it is based on how wisely they manage those assets. Whereas to say, a central bank, they're always good for it. Well, they're just getting that because they just create more, right? So that's the sense in which the central bank can always make sure it's good on what you think you have on deposit with it, is because they can just digitally create it. So in terms of as a whole, it's not that all U.S. dollar users are better off just because the central bank can create more dollars if it needs to. That doesn't make us wealthier if the central bank just creates another $10 billion. It's not like we just increased in our wealth. So that's kind of what I'm getting at there, that it only in a sense makes you whole by redistributing purchasing power from every other holder of USD assets. If the central bank has to just create more money in order to satisfy its obligations. So even though, yes, from any one individual's perspective, holding constant what everybody else on planet Earth is doing in terms of like their strategy, if you want to look at like a Nash equilibrium, then yeah, holding some CBDC that makes sense. But it's not that everybody on Earth holding CBDCs makes Earthlings safer in terms of genuine economic shocks. That no, I would say on the contrary, it makes us vulnerable to external economic shocks.
That makes a lot of sense to me, and I really appreciate you adding that. That was exactly kind of what I was getting at there. And so with that, Alex, I'd love to dive into a recent thread that you guys posted. I'm going to get it pinned right now. You guys explored recently, yours is navigating private credit risks with your full backing. And I'd honestly just love if you could walk the listeners through kind of the thread and thinking at yours around credit risk.
Sure, Jackson. Try to recap it briefly. This kind of educational threads, that's really popular, so we try to make it.
I think I lost you there, Alex.
Yeah, sorry, my mic account lags. So, yeah. Sound is back? Okay.
Yeah, we got you.
Awesome, yeah. A lot of those graphic threads try to address, people are not excited to read whole articles about it. So if you're short to the point, they might read it. And maybe they'll come back for more education later on. So you see, in the Eurozone, not many companies or individuals know that if you work with private banks, that might be risky. If you work with central banks like we do, central banks of Lithuania, if there's a bank run, you can get the refund up to 100,000 euro. That's it. And if you're a stablecoin issuer and you have millions of clients' funds, then you're in trouble. So now, because we work with a central bank and their insurance limit is bigger, higher than that, it's important to realize what kind of backing do your preferred stablecoin has, or what kind of institutions they're working with. For us, it's a public info, and we try to say, navigate this credit risk because, CBDC is good to some point. You will still use it probably for some kind of use cases. But if you go and try to do something with your savings account, like your wealth, and shift it on-chain, you have to be very careful on that. The devil is in details, as we see, and this very detail, many people just miss that. So, stablecoin issuers, they work with central bank, commercial banks, capital markets. It's hard to just wrap your head around it. So to simplify, they make these threads, make these pictures to outline, our stablecoin is safeguarded 100%. So despite how much money you pour with it, you invest, your money are protected. Whenever it's like 1,000 or 1,000,000, end of story.
It really lays it out nicely for those who want to understand the difference between the central bank digital currency in Europe right now, what yours offers in terms of mitigating credit risk, and what just the traditional consumers offered. It really is a great graphic, so I highly advise that you check that out if you haven't. And with that, another key aspect of why stablecoins will have much more utility, in my opinion, than central bank digital currencies is what you hit on earlier, Alex, in terms of the ability to leverage them in the decentralized finance ecosystem. And I'd love if you could talk a little bit about the role of stablecoins, specifically yours, in decentralized finance in terms of providing liquidity and access to that economy.
Sure. So stablecoins like ours, they basically unlock this unprecedented levels of financial autonomy, especially within decentralized finance space where users can manage and interact with assets in ways that are feasible within this traditional financial system realm. Right. While CBDC, they might centralize control, limit user balances, and be subject to stringent, governmental oversight. Whereas or other private stables, they offer this decentralized alternative. They empower users with more control over their funds. And the DeFi ecosystems, ERS provides the liquidity needed to fuel smart contracts, exchanges, lending protocols. There are basically 4 or 5 different use cases within DeFi to create a financial environment where global participants can interact without mediators, and thus fostering financial sovereignty and freedom. And of course, earn smashing yields, not just negative yields as with traditional fiat currency in the Eurozone, as was a few years back. Basically getting double-digit returns and not interacting with risky assets. So your assets are stable, they're back, they're on-chain, and you have full control over them. And you're getting double-digit yields, double that. And it's great. And you can withdraw at any time.
That's incredible. That's exactly what I was looking for, Alex. Thank you for sharing that. I'd love next to about something I saw recently in the news. I saw that Stripe had recently accepted they started accepting stablecoin payments. And in my opinion, that's huge. With more payment providers providing merchants the ability to actually take stablecoins, we're going to see the adoption continue to rise. I'd love if you could talk about just the increasing rate of using stablecoins for payments and even cross-border payments, and how yours can potentially serve as the trusted euro-backed asset for these cross-border or just point-of-sale payments.
Yeah, so the news is great in my opinion, as the adoption of stables in the payment ecosystem is rapidly accelerating this year. With many leading stables are positioned to lead to this adoption. For us, it's of course like a long way to be accepted by the top providers, and Stripe enabled stablecoin payments in over 70 countries. So yeah, we operate with different European providers as Wirex, and we have a negotiation with more providers to accept it. And we have our on-off-ramp outlines, so people can work with us in 175 countries where it's legal to accept stablecoin payments and off-ramps. And we think that it's a much needed option to blur the line between just stablecoins like crypto and traditional digital payments or line payments. So when this line is getting blurred, people like trying to interact on a daily basis, it becomes a routine, and that's it. So the click is happening, and we see the shift to more, I would say, not just crypto, by maybe stablecoin mentality, as people do not perceive stablecoin to be something risky, something out of this world, because it has been like a red word for that many years. And that many years, people have been sitting in trenches and building and doing something. Finally, they're getting reward for their work. So the seamless integration into everyday commerce will enhance the efficiency of digital payments and open up a lot of avenues for innovations. And like ERAS, ODAS could be utilized in more apps or decentralized applications, e-commerce, crypto marketplaces, point of sale systems to transform the way payments are conducted globally.
Yeah, thanks, Ed. I'll just jump in on that real quick, Jackson. So I just more generally, this is a great move that we're seeing in the financial markets and just infrastructure where, yeah, it's just so much easier now if somebody goes abroad and they're working in another country and they want to send remittances back home, that, you know, previously it could be very difficult for them to do that mechanically. And, you know, the financial intermediaries might take large chunks out of the transmissions and sort of, you know, defeating the purpose of it if it's just small amounts, you know, if it's relatively poor people or just going to a different country where their wages are higher to be able to support the people back home, that sort of thing. So yeah, just in general, just the proliferation of different ways of paying people and just moving assets around, you know, different people's possession around planet Earth that's not tied to any particular jurisdiction. To me, it's sort of like how scientists right now, you know, physicists are working on problems around the world. Yes, they're speaking in their own native languages and they're subject to different rules by their local police and judicial system, but they're all just doing physics. And so I think we're going to see as blockchain technology continues to make inroads in general finance, that over time, you know, it's just going to be that, oh yeah, the blockchain is a separate thing and the different governments of the world all interact with it, but it's not that it's controlled by one country or something. You know, it's going to be something that humanity is creating. So I think it is going to, you know, I don't mean to sound cliche, but like unify us together and things like that. Take politics out of commerce to some degree.
I completely agree there, Dr. Murphy. And thank you for sharing that as well. I'd love to move in. Actually, with 10 minutes left, I'd love to just remind the audience, we are accepting audience questions. If you do have anything you'd like us to talk about in these last couple of minutes, we do have a pinned tweet that you can drop a question under, and we'll work that into the end of the conversation here. But with that, I'd really like to talk about just the regulatory landscape in Europe versus the US. We had a whole space on this last time, so if this is something you're interested in, I highly advise you to go watch that recording. But just for the people that may not have listened to that space, we're based in the United States here, and we obviously know you guys are based in Europe. And so it would be great if you could just discuss the regulatory landscape for stablecoins right now. And if you feel comfortable potentially comparing it to the US, and if not, then we can have Dr. Murphy talk a little more about what's going on in the US.
Yeah, sure. I'll give my 5 cents. So the regulatory landscape for stablecoins and CBDCs as well at different paces in the Europe and the US, right? As people see, US innovates, Europe regulates, China replicates, right? So US was the forefront of innovation, and Eurozone right now it's introduced the markets of crypto assets regulation, which is called MiCA, right? It represents a very cautious yet comprehensive approach to integrate stablecoins into the actual financial ecosystem. And it outlined a lot of strict requirements for transparency, reserve banking, governance to ensure that stablecoins maintain financial stability and the actual customer protection. So it's pretty hard for many companies to come up with all the regulation. And out of dozens of issuers, I think that a lot of companies will basically close the shop because they're unable to deal with the sluggishness, with the some bureaucracy, or slow responses from the regulators. But in the long run, it's a great initiative. And coupled with what coming up in the Eurozone next year, which is a PSD3 initiative, it's going to be an ultimate sandbox for crypto companies to thrive, launch their projects. But yeah, regulation will be tough to deal with. But there is a unified approach, which is great. In contrast, correct me if I'm wrong, but what I've seen in the US, it is a more fragmented regulatory approach with various states and federal agencies grappling with how to regulate it. And this lack of cohesive federal guidance has led to uncertainty for market participants, though recent discussions and initiatives indicate that US is moving toward a more standardized framework. Well, this fragmented environment can create challenges for issuers and it lead to potential market disruption, as seen with delisting of some stablecoins in certain states. I'll leave it at that, and I'm happy to know more from Dr. Murphy. Thank
you. Sure. So I'm by no means consider myself an expert on this, so I'll just speak in broad generalities on this particular topic. Yes, you're right. There's a general rule. The U.S., when it comes to regulation, tends to be more fragmented than the typical European counterpart, both in terms of like federal versus state, but also even within a federal government, different regulatory agencies often have overlapping jurisdictions. They might argue about, hey, who's in charge of regulating this particular thing. So that's certainly an element. Also, I think this it will make a big difference as to who wins this upcoming election. That I think people believe that people who are in the crypto space in the United States think that another Trump administration would probably be friendlier, not necessarily like just wide open, but more like working with companies and just trying to say, okay, here's the rules you need, here's the regulatory certainty you need to be able to build a business. Whereas, Harris administration might be more hostile. So I definitely agree with that assessment. And the one last thing I'll just say, though, what I do think is coming eventually is that, and you see various senators and other people talking like this, is I think they're going to have a push to treat stablecoin issuers as if they're just banks. That, because if you think about it in terms of like its economic function, there is a sense in which if you wire a bunch of, USD conventional funds from your regular checkout to a stablecoin issuer, and then you get some USD stablecoins, that's kind of like that they're a bank and you open up an account with them and gave them some currency, and now you have a check that a lot of merchants will accept. And then you have to wonder, what are they doing with those reserves, right? And so likewise with the stablecoin issuer. So I think that as stablecoin adoption becomes bigger, I think you're going to see more and more of a push, because all it's going to take is one major one to go down, and then lots of people to say, oh, wow, I had 3 months of my savings, and that's that stablecoin issuer, and I thought my money was safe, and it wasn't. And so then you're going to see, people coming in and saying, well, if they're going to be acting like a bank, then they have to be regulated like a bank. So I think that's what's probably going to come.
And that's exactly what is coming, Dr. Murphy. And Alex, that was a great summary. You put it perfectly. I just want to add a little more specifics to that. In the U.S., we have seen some legislation get introduced to do exactly what you just described, Dr. Murphy, and really help regulate the reserves for stablecoin issuers. So in the Gillibrand Payment Solution Act that was introduced back in April, they proposed requiring one-to-one reserves for all stablecoin issuers, also prohibiting unbacked algorithmic stablecoins, like we mentioned earlier, and then a lot more things such as creating regulatory regimes and allowing state trust companies to issue stablecoins up to $10 billion. And then I'd also just like to note that recently in this October, Senator Haggerty released a discussion around stablecoin legislation that would do that same thing, exempting issuers of less than $10 billion from federal regulation. But he also tried to designate the Federal Reserve as a supervisor for depository institutions issuing stablecoins. But while we do have more fragmented and developing framework in the US, there are some exciting developments going on right now. And with that, with our last 5 minutes here, Alex, I'd love if you could just tell us a little bit about how you see the future of the digital payments industry growing, and specifically how you see yours continuing to grow over the next couple of years.
Thanks, Jackson. That was a great conversation and a lot of insightful details, although I would love to have it like 2 hours to completely discuss all the points. But thanks again. To wrap it up, I think that stablecoins adoption is inevitable. In the Eurozone, there will be a continuing shift for locally procured stables, so to see. Next year is going to be year of CBDCs probably, and probably a lot of people is going to be disappointed by the product. They will try it out and will go for private stables. So, they will not take any kind of market share from us. And even though we anticipate more people to try out this, I would say like pseudo crypto technology and to try out next what the real thing is, and to embrace the fully backed, fully transparent Euro stablecoin for their payments. And hopefully, as we have more use cases, not just payments, but real life utilities, as they will probably have the possibility to pay for their utilities, the bills, etc., maybe smaller payments. This year, we had dozens of creations, partnerships, and we don't part with meme coins. We partner just for the sake of utility. Most of ours consist of hardware projects, that is real estate, payments, tokenization sector. Let's say when all this comes to fruition, there's going to be a lot of different frameworks to experiment, to pay with ERS for something. Let's say the tokenized share of maybe a whiskey, maybe a house, maybe something else. But real estate sector is very promising as a whole different topic to discuss maybe next. And of course, we'll continue to innovate in the DeFi space. We'll add more blockchains, as multi-chain is the way to go. 7 blockchains is not enough. 1,000 blockchains is not enough, and we'll certainly embrace more. Another topic to discuss maybe for the future is how this DeFi space is fragmented. We don't have unification there. You see a great project in Solana and you cannot integrate with it because you don't support Solana. Well, it'll be there. Will be more blockchains. And of course, innovation and partnerships is part of our roadmap. More blockchains and more high-level integrations with bigger companies to accelerate adoption within Eurozone sector. More partnerships on the international level, as we have 5 partners, some partners in Latin America and Asia. We want to make our international presence more robust, solidified. And so CBDCs, they will come, it's an inevitability, and it's great. People will try it out and they will choose for themselves. Smart people will choose less risky product with more benefits. And I think the future of privately issued stables is bright. Thank you, Jackson.
Thank you. Thank you, Alex. And for those listening, where could they stay in contact with you and yours? What would be the best way to Stasis and yours? What would be the best way to do that?
Yeah, surely. Go ahead at Stasis.net. Check out a lot of extensive info. We try to structure it conveniently as it's third redesign of our website, so we can learn a lot before stablecoin, our history, our transparency action, and we have a blog on the website and the Medium channel. It's all there. You just hop in, you explore, and you dive into the details, and you start with us. And there's a button to actually go through KYC and try and buy your stable. If you're not comfortable with the KYC, we have something called instant verification, which is actually a zero KYC. You cannot really see it on the website, as the regulators will shoot you on site, but it's what it is. You just put on your email, your phone, and you can buy up to €1,000 without any kind of verification. Just, try it out, see for yourself. And of course, follow the Twitter of Stasisnet. The account is also on Space. It's our major communication hub. We also have a TG and Discord, but it's smaller significance. So all the news, we're going to have a lot of updates on a daily basis. Thanks again.
Thank you, Alex. And I highly suggest getting them a follow. They post really, really great educational content in the stablecoin and CBDC space, as you can see in the pinned tweets here. So I just want to thank you, Alex and Dr. Murphy, for being here today. This is our bi-weekly real-world asset tokenization space. Today was our conversation on CBDC and stablecoins with Stasis Yours. And we're very excited to have our next space coming up on the 29th of October, where we're going to be having Particula on. And so if you want to stay in contact with Infineo, the best way to do that is going to be to follow this account and then additionally subscribe to our newsletter. You can do that by going to infineo.ai/#newsletter. That's infineo.ai/#newsletter. Look forward to seeing you guys on the next space, and thank you all again for being here. Have a great day, everyone.